Okay, question one says a client is considering the purchase of ADRs. The client is looking to further diversify her portfolio. Which of the following is not a feature of this type of investment vehicle? You talking to me? No, I'm doing this thing. Okay. I'm narrating stuff. A, information regarding the foreign company is more easily attainable than if directly purchased. B, ADRs are denominated and pay dividends in US dollars. C, they are not subject to exchange rate or currency risk. Or D, ADRs are both liquid and marketable. So the answer is C. They are not subject to exchange or currency risk, because even though they're denominated in dollars, they are still subject to the foreign stuff. The bank does give information about it in English rather than foreign language, and they're traded like domestic stock. Question 2. Reasons why a corporation may want to issue a convertible preferred stock would be, is it A, to lower costs to the issuer than would be incurred by issuance of convertible bonds? B, tax savings to the user? C, giving those shareholders the ability to convert into issuers' bonds? Or D, giving those shareholders an opportunity to participate in the future success of the company? The answer would be D, giving opportunity to participate, benefit, is the ability to convert into the stock later. Allow those investors to benefit from the growth. It never converts to a bond. There are no tax savings since it's an after tax, and there would be interest, and stock is a lower claim than bond, so the dividend rate would be higher. Which of the following statements regarding ADRs are true? 1, securities are vehicles used to facilitate U.S. trading in foreign securities. 2, dividends are received in the foreign currency. 3, holders have foreign currency risk. Or 4, the receipts are issued by a foreign branch. So if you look at those 4, the answer is B, 1 and 3. Securities are vehicles to facilitate trading. That's pretty straightforward. 2, you knock out because you get paid in dollars. Holders do have foreign currency risk, which seems to be a common theme. They're not issued by a foreign branch of a domestic bank. They're issued by domestic banks. It says that down here as well. So next. The client has 100 shares of GSHI when the stock undergoes a split. After the split, the client has A, proportionally increased interest in the company, B, greater exposure, C, proportionally decreased interest in the company, or D, no effective change in the value of the position. Start giving you a second in case you want to pause the video and think about it. But the answer is D, no effective change in the value of the position. It just is a way to mess with the stock price if it's getting too high or too low. That's what it says down here. Number of shares increase, or in the case of a reverse split, decrease, no effective change in position. Which of these is among advantages of including preferred stock in an investor's portfolio? Maturity date shorter than that of debt securities offered by the same issuer. Rate of return is likely to keep pace with inflation. Dividends must be paid before any distribution to common stockholders. Or there's an opportunity for increased income if the issuer's profits increase. So the answer here is C, dividends must be paid before distribution to common stockholders. Fixed dividend puts you ahead of the common stockholders. It may not keep up with inflation because it's a fixed return. Regardless of earnings, it doesn't change. You can't increase your income. And unlike that, there's no maturity date. Rule 144 applies to the sale of all the following except A, registered securities, by an officer of the issuer. B, unregistered securities by an office of the issuer. C, unregistered securities by a non-affiliated shareholder of the issuer. Or D, registered securities by a non-affiliated shareholder of the issuer. So let's see. So it's either registered or unregistered, or it's affiliated or officer. So it looks like 144 applies to registered and non-affiliated. Applies to the sale of unregistered, except. Sorry. Let's take a look at that again. So the things that combine the two together, 144 applies to unregistered and either one, affiliates or non-affiliates. So the only ones that doesn't meet that is D, registered securities for non-affiliated issuers. Which of the following statements concerns international direct investing is correct? A, the rate of return on foreign securities are generally less than those available in U.S. The addition of foreign securities to a portfolio may result in an increased portfolio risk due to the different movements of foreign markets and U.S. markets. Foreign markets are usually more mature and offer no growth advantages. Or D, information is not really available in foreign investments as in domestic ones. So this one seems pretty straightforward. There can be some pretty high growth stuff, so you could have higher rates of return. Your portfolio risk should go down because the markets don't move together, so you have some diversification, so it's not B. C does give you some growth advantages, so the answer is D. Information is not really available. They don't have as much transparency, and that's why that answer is you picked. I'm going to talk through the things I said there. Which of the following statements regarding ADRs are true? Another ADR question. Large domestic commercial banks by foreign banks, foreign securities, foreign investor wants to trade in U.S. So if we look at this one, it's usually one of the first two and one of the second two. They are by large domestic banks, and they are the way for U.S. to get involved with foreign securities like BASF 1 and 3, which would be D, and that is correct. The primary defining characteristic of an equity security is pays dividends usually quarterly, represents ownership in a corporation, voting rights, or the ability to keep pace with inflation. In an equity security, equity basically means ownership, so that means B, ownership in a corporation. Many can pay dividends, but you don't have to. Could include preferred stock with a fixed dividend. It doesn't offer inflation protection, so B is the answer. Which of the following statements concerning equity securities is not correct? Preferred stock is an equity security with an intermediate claim on the firm's assets and earnings, somewhere between bonds and stocks. Equity securities represent a lending interest in the corporation. Common stock is an equity security representing ownership. Equity provides a residual claim after payments to fixed income and everybody else. So that's right. The stockholders are always less. Does have ownership. It's some preferred stock. It's kind of like a stock and kind of like a bond. So B, it doesn't represent a lending interest, which would be a bond or some sort of debt. So the answer here is B is not correct. Which of the following statements regarding preemptive rights is true? Common stockholders do not have the right to subscribe to a rights offering. Both common and preferred have the right to subscribe to a rights offering. Preferred stockholders do not have the right to subscribe to a rights offering. Or D, neither preferred or common have the right to subscribe. This one I don't think I would have known, but the answer is C. And it says down here, preferred stockholders have a preference as to liquidation and distribution dividends, but the right to maintain a proportional interest in the company only applies to common stock. So I guess that means if they're going to issue more stock, if you're a common stockholder, you can keep your percent ownership the same before they do that, but preferred stockholders have no such option. Investor in an equity security has a say in the day-to-day operations, becomes a creditor, acquires an ownership interest or the assured minimum rate. That one's pretty easy. C, ownership interest. Customer owns cumulative preferred stock that pays 8% dividend. The dividend is not paid this year or the previous 2 years. How much must the company pay the customer per share before it pays dividends to everybody else? So it missed it 2 years, 8%. So it's going to be this year's and the previous 2 years, which should be 8 times 3 or 24. Make sure the explanation is correct. All dividends, they're 16 and back from the previous 2 years and 8 from this year, so 24. It's not the quarterly dividend, it's written as an annual dividend. Investments in which of the following offers best long-term protection against inflation? Common stocks is the answer. C, they have historically outpaced inflation. Fixed returns have the greatest inflation risk, and the rest of these are all pretty much fixed returns. Investor may expect to see dividends from not a put option, there's no dividends with that, an ADR, a call option, or a warrant. An ADR is the only one that rates in a foreign corporation, and dividends have to go to the ADR owner. Which of the following has the least exposure to inflation risk? Again, it would be common stock. They've outperformed inflation again. Which of the following best describes cumulative preferred stock? Allowed to vote, lose any claim to dividends if they aren't paid in a year. Owners have a continuing claim to dividends in all areas, must be paid before it can pay on common stock. They get an extra dividend. So extra dividends not right. They're not allowed to vote. They don't lose claims. It adds up in this area. So the answer is C. An employee wishing to obtain long-term capital gain treatment would prefer the employer to offer listed stock options, portable stock options, incentive stock options, or non-qualified stock options. Which one is long-term capital gain? It says here the answer is C, incentive stock options, and it is because if the time limit conditions are met, exercise of an incentive stock option can result in long-term capital gains, or any of the non-qualified options are always treated as ordinary income, which these other ones must be ordinary options.